We've got a little bit extra ground to cover, so I want to make sure we do that. We're in module 15.2, and the main objectives here will be to cover accounting for cash and stock dividends. So make sure this is up on the screen so you can see that. So we're going to do cash and stock dividends. That's our learning objective. Then we should look at share repurchases, and we will do that as well in 15.3. So these are ways in which stockholders' equity changes aside from issuing common stock and, of course, the closing of net income to retained earnings. Now, when we look at the dividends, the two primary types, and again, this is 15.2. Two primary types of dividends that we're going to look at are going to be cash dividends and stock dividends. There are other types of dividends as well. All dividends are generally, or most dividends are paid out of retained earnings, with the exception of dividends that come out of surplus or paid in capital. These are known as liquidating dividends. Liquidating dividends simply mean, in our definition, that a dividend is not paid from retained earnings. Now, another type of dividend is a property dividend, and that's where the corporation will unilaterally distribute shares of a division or a subsidiary. So, for example, you might have the case of General Motors with Delphi Motor Parts, or their supply division for their parts. They essentially incorporate a division. Those shares, they split this off from the company, spin off the entity, and they just give shareholders shares of stock of the other entity, and that becomes a property dividend. Now, the most common will be cash and stock dividends. Let's do the cash dividend first. On a cash dividend, we have a distribution of corporate assets, obviously cash, to the stockholders. The net effect, you can see on the screen, is a debit to retained earnings and a credit to cash. This is cash flow from financing activities. You should know from the basics of accounting that when you have a cash dividend, we have three dates. The first one is the date of declaration. Second date is the date of record, which we'll talk about a little bit more. And the third is the date of payment. So let me make sure we line these up. We have the date of declaration. We have the date of declaration, date of record, which is really effectively the ex-dividend date, and then the date of payment. So let's go through each one. On the date of declaration, let me go back to that. That is where the legal liability is created, and this is only for a cash dividend, right? Only for a cash dividend. Okay, so legal liability is created by the declaration of that dividend. Date of record and ex-dividend date get quite confusing. So in order, and I have another example which I could post on Blackboard from Home Depot. Essentially, the record date is really just an announcement date. The real primary or the most important date is the ex-dividend date. So let's take a look at my illustration. It says that on June 1st, we declare the dividend. That's where the legal liability is created. We have an ex-dividend date. This is the date that if you own the stock prior to that date, you would receive the dividend. So if the ex-dividend date is June 15th and you buy the stock on that date, you don't get the dividend. On that date, the stock price drops by the amount of the dividend per share, right? On June 14th, if you own the stock, you get the dividend. So the ex-dividend date is the date that the shares will trade without dividends being paid. That's what it means. So the ex-dividend date is the date that the shares will trade without the dividends being paid. And on the 17th, that's the date we announce who owned the stock on June 14th. And then the payment date when the liability is paid is July 7th. So to see this, you really need a timeline, and here's the way it would look. On June 1st, that's the date of declaration. The legal liability is declared. Now, the date of record, that's where there's no journal entry. The transfer agent or registrar determines the ownership on June 14th. Now, the ex-dividend date is typically 2 days before the date of record. Why? You need time for trades to close. So I just can't say the record date is the 17th, and if you own the stock, I'm not going to know that. So I may need, and depending on the stock exchange, I need 2 days, sometimes 4 days, to have the shares settle, the transactions clear, and I know who owns the stock. So I go back, and on June 14th, I get a list of who owns the stock, and then I announce that that is the date that you must own the shares in order to get the dividend. If you purchase the stock on the 15th or after, you would not receive the dividend. The shares trade ex-dividend. So if you buy the stock on any date after June 14th and before the payment date, you would get a stock price that's reduced by the amount of the dividend per share. And then on the date of record, you're essentially announcing who owns the stock on June 14th, and you pay it on the 7th. Now, this entire process could take a couple of days, right? Because it takes time, especially international trades, it takes time for trades to close. If, for example, if you had a trade on Tuesday and you called a broker or did it online after the market closed on Tuesday afternoon, you may not see that trade hitting your account until maybe Wednesday, maybe even Thursday, depending on how the transaction is processed. Now, for us, the only dates we worry about from a debit and credit standpoint are the date of declaration and the date of payment. So, something you should know from accounting 1, let's take the entries and let's assume that I'm going to pay or declare a dividend on the date of declaration in entry A for 200. That's the date I debit retained earnings and credit cash dividends payable. This is a non-cash financing event on the cash flow statement. The liability is created on the date of declaration. In B, which is the record date, there's no entry. This is handled by the transfer agent and the registrar. Transfer agent and registrar, depending on what topics you covered in auditing, plays a critical role in the audits of stockholders' equity in those equity transactions. And then finally, when you pay off the dividend, you will debit the cash dividend payable in entry C and credit cash. Now, that's a financing cash flow. So the only entries, and again, this is the ex-dividend date and the date of record, are going to be handled by transfer agents, registrar. Doesn't affect our debits and credits. The only effects that we need to worry about are the date of declaration and the date of payment. So sort of back to basic accounting. Any questions on a cash dividend? And remember, there's a liability here, so we use the term payable. We use the term payable. Any questions or any comments on cash dividends? You've seen this before, I would think, right? Intro to accounting somewhere? If not, Any questions anyway? I want to make sure I go over it. Okay. Now, what I know you didn't see, stock dividends. Stock dividends are used often. They're generally used to either avoid passing a dividend, or usually it is a supplement to a cash dividend. A stock dividend, we say, permanently capitalizes retained earnings. Essentially what it means is that when you have a stock dividend, you are reducing retained earnings without using assets, so that retained earnings goes down, but the assets stay in the company. Those assets could be plowed back. You could invest in capital, and therefore you can grow the company through capital investment. This is sometimes, or expansion. So it's sometimes called a plowing back or permanent capitalization of retained earnings. Don't forget, if retained earnings are reduced, it might mean you can't pay dividends out based on loan agreements. Remember, we looked at restrictive debt covenants last semester. So if you have a loan agreement that restricts dividend payments, if you reduce retained earnings by a stock dividend, even though you might have excess cash, you can't pay based on the restrictive debt covenant. So this may allow you to sort of retain assets in the company or grow or expand by making capital investments. Now, the most important piece of a stock dividend, and let me show you the sort of the lineup. First of all, a stock dividend, and let me go to the second first. Let's go to the equation. A stock dividend has no effect on total assets, liabilities, and no effect on stockholders' equity. All a stock dividend does is transfers retained earnings, and there are exceptions. We'll talk about the exceptions. Transfers retained earnings into contributed capital. It's really nothing more than a reclassification. So you take retained earnings and you put it into contributed capital. In addition, if you look at the total book value of a company, it doesn't change. The total market value or the capitalization of the firm doesn't change either, unless there is a signaling effect, which I'll talk to you about in a second. However, book value per share declines, and typically market value per share will decline. Now, what's the signal? It's very much like a stock split. A stock dividend is very much like a stock split. A stock dividend could be a signal of higher cash flow expectations. Why? Well, let me set up the answer for you. If you see a company is now giving shares to shareholders, what happens in the future if they declare a dividend? They have to pay it on more shares. Therefore, it's a signal that management has higher cash flow expectations. So typically, the stock dividend is probably going to be a signal that the company is expecting higher earnings and cash flow, and therefore you might see some bump up in the market price. Happens with a stock split also. We'll talk about that in just a minute. So again, mechanically, there is no change in total assets, no change in total liabilities, no change in total stockholders' equity. The market value of the company, aside from the signal, will not change. The book value of the company doesn't change. Of course, per share, it will drop. Now, if you think about no changes, and I've been arguing, people always argue with me, well, what did you do? You gave them nothing. Therefore, we shouldn't do anything. But there's always accounting. And we do have an accounting valuation issue here. So the question is, how do we value the stock dividend? And by the way, the most important thing to remember is that because there is no change in any of the accounts, no asset change, no liability change, and total equity doesn't change, there's no liability. So a stock dividend does not create a legal liability. even if it's declared. Even if it's declared, it can be reversed by the board of directors. And the reason why there's no liability, you didn't promise to give anybody anything. There's no promise to distribute corporate assets. So there's no liability to distribute any assets. Now, that leaves you with the question is, why do you value the stock dividend? And what we're going to look at are pretty much rules that have been around for probably about 70, 75 years. They came from the New York Stock Exchange and the Securities and Exchange Commission, and the valuation is going to be based on the size of the dividend, and it is a bright line test. It is a materiality test, and we're going to use a bright line of 25%. Essentially, we're going to look at dividends as being classified as either stock dividends, as being classified as either large or small stock dividends. And again, not very creative, but it's based on materiality. The small stock dividend, now I'm going to go with up to 25%. SEC defines it as less than 25%. The GAAP standards define it as between 20 and 25%. Essentially, if you read this carefully, and this is key, unless there's evidence to the contrary, we assume that a dividend of up to, and again, all of this is based on your notion or your other information regarding materiality. Up to 25%, and we're going to go up to 25. I'm going to give you a clean cutoff just for exam purposes. Up to 25% of the previously outstanding shares, we would say that yes, stock price will decline proportionately, it has to. But 25% is not material. Unless you have evidence to the contrary. And you use the market price on the date of declaration. Okay, so if you have a stock dividend that represents up to 25% of the previously outstanding shares, price declines, yes, but it's not considered material enough unless there's evidence to the contrary to negate the use of the market price. Market price is going to be used on the date of declaration. The closing price on that day is the price that we would use to value the market price of or the stock dividend. Now, stock dividend valued at market is the only way you can do this under IFRS. So once again, if we had IFRS going, we'd be done with this already because there's a market value and that's it. Under IFRS, they call these bonus shares or capitalization issues. Bonus issues or capitalization issues of stock. And they are, in fact, always valued at market. Under U.S. GAAP, however, we now have a large stock dividend. And unless there is evidence to the contrary, we would say that a stock dividend of over 25% will result in a material decline. And again, we know that the market price will decline. Over 25%, we expect stock price to decline materially unless there's evidence to the contrary, or there could be a signaling effect. If that's the case, we value at par, or I'll get to this. We'll use what we call stock split treatment. Now, I'll get back to that. And the reason for it is small stock dividends are called ordinary. Large stock dividends are really sometimes called stock splits in the form of stock dividends, because a 50% stock dividend is really a 3-for-2 stock split. It's really the same thing. So accounting-wise it's different, but economically the effects are very, very similar. Okay. Now, that's the theory. It's based on materiality of the price declining, the significance of the decline. At 25%, unless you have evidence to the contrary, that decline is not significant. Use or value at the fair value on the date of declaration. If the decline is material, over 25%, we use par or stock split treatment. Now, stock split treatment, just to tell you, is pretty simple. Just means that if there's no par value, there's nothing you can do, right? I mean, if you have a large stock dividend and there's no par, you don't have a value to use. So what do? You just change the disclosures. What gets changed? I'll show you. You change the number of shares issued, the number of shares outstanding, correct? So the disclosures are going to change. Or in some states, you could treat this as a liquidating dividend, in a sense. Take it out of paid-in capital. So basically, when you have stock split treatment, the key is that it doesn't reduce retained earnings. So when you see this term, stock split treatment, it does not reduce retained earnings. That's the key. It either only affects disclosures or comes out of paid-in capital. So it either only affects your disclosures or comes out of paid-in capital. Okay. Now, what I want to do is first see if you have any questions in the theoretical side or on the theoretical side. And we're going to go through an illustration. And by the way, we're going to assume that Treasury shares do not get stock dividends. They do in some states, but we're going to try to keep it simple. So any questions on the theoretical side of this? On why we're using one value versus another? Why do we use par? Why do we use the market? All right, let's take a look at, I guess it's page 5. I just want to be sure because sometimes pages are different. Now I want to go through this illustration, and you can see I'll leave it up on the document camera as well. I'll get back to that. Here's a situation where we have a company that gives, all these numbers are given. So you've got $10 par value, 200,000 shares authorized, 110 issued. Common stock, 1,000,001. Excess over par, 480. Then you got retained earnings of 2 million, and then we have treasury stock of 10,000 shares at a total cost of 400,000. We'll get back to how to account for treasury stock a little bit later today. The average cost of treasury here is about $40 a share. You should also note that the book value, I'm just going to highlight this because we're going to go back and keep looking at this. The book value of this company is $33,180,000, and when we look at the number of shares, the most important thing to remember is when you're looking to value the stock dividend, we have to think about the previously outstanding shares, and those are issued minus what? Treasury. So if you look at this, you've got total issued shares 110, treasury stock 10,000, so there are 100,000 shares outstanding. And I'll show you this a little bit later as well. On top of that, what I want you to see is that the book value per share is $3,180,000 divided by 100,000, or $3,180. And we know the stock has a par value of 10. And I tell you to make the following assumption. Let's assume, and the stock is selling for under book value, that could happen. Happened a lot during the recession. Stock dividends declared on a date when the firm's common stock is selling for 30. Par is 10, market is 30. We're going to assume that we use newly issued shares not to get involved with treasury stock, and we also assume the treasury cannot get stock dividends. Some states allow treasury to get stock dividends. Treasury does not get cash dividends under any circumstances, but they could get stock dividends. Now, two independent cases, and this is, I think, relatively easy. Case number one, we want to determine how to account for this dividend, and on an exam you don't have evidence to the contrary. So I'm going to tell you that the number of shares of the dividend in this case are 23,000, and in case B it's 26,500. Now, if I'm in case one and I know that I have 100,000 outstanding shares, then of course the type of the dividend, based on what we know in the theory without evidence to the contrary, the dividend is under 25%. It is assumed that there's no evidence to the contrary. The decline in market price is not considered material. The bright line is 25%. You fall below that bright line, therefore it's not significant, and we value at the market price on the date of declaration. So this stock dividend will be valued at 23,000 shares multiplied by $30 a share, or $6.90. This means that when you look at the journal entry on the date of declaration, you have $30 a share times 23,000, or $6.90 debited to retained earnings. The par value, 23,000 shares times 10, which is the par, and 23,000 shares times 20, which is the excess over par, or 460. Notice also the term distributable. Now, as I said, that's going to be at par or stated value. As I said, I'm not always picky on terms, but in this case, if you put stock dividends payable, you have to realize that you're wrong, because stock dividends are not legal liabilities. Remember, we said even if declared, there's no liability to distribute. So if you're looking on page 5, you'll see the journal entry will tell you that you credit an equity account called stock dividends distributable. Now, in the event that the shares are not issued, stock dividends distributable sits in the stockholders' equity section. This is a stockholders' equity account. It sits in the stockholders' equity section. at par or at stated value. In addition, it is not a liability, so you can't call it payable. Incidentally, the investor has no entry to make. You know, the dividends just lower their cost per share, but that's it. So if you had, you know, if you had 5,000 shares and I now give you another 1,000 shares, you have 6,000 shares, but your total cost doesn't change. Your cost per share goes down, but nothing changes. So the investor has no entry to worry about here as well. Now, when I distribute the stock, or issue the shares, I debit the distributable account and I put the 230 into common stock. So you take it out of one contributed capital account and put it into another. Debit, stock dividends, distributable, and credit common stock. So again, I think this is really relatively easy. The valuation becomes the question. Any questions, assuming that the declaration and the issuance of the shares is the same period, any questions on the entries? You debit retained earnings for the fair value, common stock at par, excess goes into common stock distributable at par. That's an equity account, it's not a liability, and the excess goes into paid-in capital. Then when you issue, you debit the stock dividends distributable account at par and credit common stock at par. Any questions on the entries? Again, this is at par, at fair value. Now, what I wanted to show you is, in comparison, what happens at the end of the transaction. Well, first of all, notice in the highlighted area, the yellow highlight, on the number or the dollar amount of book value does not change in total. Because all you did, if you look at the change column, all you did is move retained earnings here into contributed capital. I'm sorry about that. Into contributed capital. So you just moved $690 of retained earnings out and moved it into common stock at par and excess over par. On top of that, if you look at the number of shares now, notice that when we had the original amount, we originally had 110. We now have a stock dividend of 23. So that means that you now have the number of shares, because we assume they were newly issued shares, of 133. Then, of course, if you take away the treasury stock, you now have 123,000 shares outstanding, which is nothing more than the original outstanding shares divided by, or added, I said, to that, I should say, the 23,000 of the stock dividend. And then finally, before we go to the second case, the book value per share, as we said, total book value won't change. But book value per share drops to $25.85. So stock dividends really just move capital or equity in the stockholders' equity section. Questions on the effect after the declaration and the issuance? Remember, in between, if I declared in 2014 and issued in 2015, there would be an account up here called common stock dividends distributable. It would sit in stockholders' equity if it was in between. Yep. If you use treasury stock, it gets complicated because there are gains and losses on treasury stock. It would convolute what we're trying to show you. I mean, I can, well, because there could be gains and losses on the treasury, you'd have to know what you paid for the treasury. But the net effect, I mean, should be, let's see. So if we use treasury here, it should pretty much be the same because it won't change the issued shares, right? So, I mean, if you left the, in this case, instead of having 133,000 issued, if you use the treasury, you would take it out of there and you wouldn't change the issued amount. And that won't change, but all of the numbers will be different for the gains and losses on the treasury. Of course, these numbers would pretty much stay the same. All right, any other questions on that? All right. Now, the large stock dividend case, this simply means that, all right, I've got a stock dividend now of 26.5 that exceeds the materiality level, and now we're saying it's over 25%, so the decline in market price will be significant. You realize the market price of this stock starts at 30 on the date of declaration. As soon as the market's impounded, it's got to go down proportionately. In this case, you capitalize at par, which is $10. So you debit retained earnings, credit stock dividend distributable, and then, of course, debit the stock dividend distributable and credit common stock. Everything's at par value, $26,500. Again, it's $265,000 going into contributed capital from retained earnings. The 26.5% is material, and we can't use the market price of the stock unless there's evidence to the contrary. Now, in the balance sheet, once again, there's no change in total stockholders' equity. The book value in total doesn't change. You're shifting, once again, you shift retained earnings into contributed capital. And you're doing that at par. Now, in this case, again, assuming no treasury stock is used, and we have a stock dividend of 26,500 shares, you have issued now 136.5, and 126.5 is going to be outstanding. And of course, the book value per share is also going to drop. This time 25.14. Total book doesn't change, but if you divide that by 126.5, if you divide 3,180,000 by 126.5, you get your 25.14. And that's your revised book value per share. So the only difference between a large and a small stock dividend is basically the hit that you take to retained earnings. Now, depending on the state, you could give this stock split treatment. And as I said, in stock split treatment, you don't have any effect on retained earnings. Okay, now, before we get there, let's see if you have any questions. So let's take a good look at this. Think about the large and the small stock dividend, of course. Thinking about the theory, number one, and the journal entries. So do we have any questions on stock dividends, large or small stock dividends? And remember, IFRS only uses small stock dividends. In a sense, they don't call them small stock dividends, but they value all of their stock dividends at fair value. Now, depending on the state, you could give this stock split treatment. Stock split treatment simply means that you don't impact retained earnings. So if you take a look at page 7, of course, if there's no par stock, all you're going to do is change the numbers in the balance sheet if there's no par. So in other words, if you go back here, all you're going to do is change these disclosures. If there's no par, you would basically have everything up here. There'd be no excess over par value, and you would just change the number of shares issued, and that's it, if it was a large stock dividend with no par. If, however, it has a par value, in some states, you could treat this as what you would think of as a liquidating dividend and take it out of paid-in capital. So at declaration, rather than debiting retained earnings for par value at $265,000, you would debit the paid-in capital account and credit the common stock dividends distributable or stock dividends distributable at par. And then when you distribute, you would debit the distributable account and credit the common stock. So stock split treatment, no par stock, you just change disclosures. If it is a par value stock and the state allows, or if I tell you to use stock split treatment, instead of debiting retained earnings for a large stock dividend, you debit the additional paid-in capital. And some states permit additional paid-in capital to be reduced. And I will tell you again, when we cover treasury stock, you cannot reduce paid-in capital below zero. Retained earnings could have a negative balance, which we call a deficit, but you can't reduce paid-in capital to a negative balance. So obviously, liquidating dividends are not something you can do on a permanent basis. And finally, just to make sure we're clear, on a stock split, very simple, nothing happens to the dollar amounts. No changes except for the disclosures. So that you get a new authorization. So if, just for example, on page 7, before the split, you got 10,000 shares of $10 par value. If there's a 2-for-1 split, we double the number of shares and we cut the par value proportionately, meaning that now you've got 20,000 shares of $5 par. Nothing happens in the line items on the balance sheet because the dollar amounts stay the same, but the disclosures of par and the number of shares authorized, issued, and outstanding will change. Just remember, when the shares split, everything splits. Authorized, issued, outstanding, and treasury will split. So all shares will split. And a stock split, very much like a large stock dividend, has a signaling effect. Most people think, when they look at a stock split, most people think that stock price is very high before the company splits the stock, and then they split it in half, 2-for-1. Why do they do that? What's the common reason? Make it more liquid, make it more affordable, get more trading in those shares. That's not the only reason. The other reason for it is sometimes thought of as a signal, just like a stock dividend is a signal, because now if dividends go up even by a penny, you have to pay on twice the number of shares. So that it signals that management has higher cash flow expectations, and the market generally reads that as a positive signal, and the stock price tends to tick up after the split, usually. And the same thing is true for a stock dividend. Now, when you think about the cash dividends, what happens to cash dividends after they split? They get cut in half as well. And as long as the dividend does not get cut by more than the proportion of the split, you're okay. If a company splits the stock and cuts the dividend by more than, let's say, 50% here, you got a problem. It's a negative signal. So again, stock splits, just like large stock dividends, have a market signaling effect, and probably the market price will tend to go up based on the expectation that management has higher cash flows projected in the future. But again, the stock splits and large stock dividends are considered to be relatively similar in their market effects. And in a lot of ways, again, I think I mentioned a 3-for-2 split is the same as a 50% stock dividend. So they are very similar in nature. However, the accounting is completely different. In fact, For a split, there is no accounting. There are no debits and credits. You simply change the disclosures. Yep. Right. Yep, and you probably would use the stock dividend as a supplement, not as a replacement for a cash dividend. Because if you did, it would be probably a negative signal. I mean, you may have to, but usually most companies are using stock dividends as supplements. A large stock dividend? Yep. Mechanically, yes. Yeah. Again, it's going to. I don't think the company is going to base their dividend decision on the retained earnings effect. That's just a side effect. I think an accounting effect, because really there's no real. That's right. Yeah. Yeah, and whatever happens to retained earnings is a side effect. It's really, I think the economics here is the level of dilution or the effect they're looking for in terms of stock price adjustment, just like a split. You know, do you want a 2-for-1, a 3-for-1? Do you want a reverse split? It depends on what you want to happen to the market price. Now, we get stuck with the valuation issue, which I think is somewhat artificial, because a lot of people believe we shouldn't do anything. You know, just change the disclosures because in reality, you're not, I mean, there's no way that you are really giving somebody $30 a share. Because on the date of declaration, it's 30. As soon as the shares hit the market, the stock is going to drop by 23% or 26.5%, just like a 2-for-1 split. So that's like saying, why don't you value a split at, you know, market price? It's not very sensible economically or from a finance perspective. It was done, and I think the driver there is that the SEC and the New York Stock Exchange wanted companies not to use stock dividends, but rather to split their shares. And the retained earnings hit is the detriment, or at least the deterrent, to using small stock dividends. It's probably to close. I have to check the SEC rules, but that would affect, it may also impound the dividend itself. And even the rumor of the dividend itself could impound that, right? Because if it's the opening price, then of course you're not capturing the dividend, but then again the dividend's announced anyway, so it's probably impounded. So I'm pretty sure it's the close. And sometimes the SEC uses, even for mergers and acquisitions, a price that surrounds the event date, like a week before, to take the price or the average price. Yeah. The other thing, if you think about the split versus the stock dividend, today companies have substituted stock dividends for discounts. So they call them stock dividends, but they're saying, we want you to buy our stock and we'll give you 10% or 20% off of the issue price or the market price. And that becomes like a way to get more trading or more liquidity in their shares, and they're giving you sort of a dividend. So the dividend is a dividend in kind, and these are dividends in kind also. They're not cash. So they give you a discount on that as well. So I've been seeing more of that. Whether or not that's going to be the wave of the future, I don't know. But stock dividends are out there. They happen. A lot of companies use them. And as I said, it's probably most likely as a supplement, not a replacement. Okay, good questions. Any others? All right, let me ask you a couple of questions. Then we're going to move on to treasury stock. Okay, so with the first two questions here, let's do the first one. All dividends, except for liquidating dividends, reduce total stockholders' equity. So let's think about that. You'd have to know all types of dividends, cash and stock, and you have to know what a liquidating dividend is on this one. Okay, so all dividends except for liquidating dividends reduce. Total stockholders' equity. Let's see what we have. Okay. Very good. Can't argue with you. All right, so that is correct. It is false. But of course, as always, why? How would you explain that? What's going on? Why is that not? Well, first of all, I know the easy answer is it says all, and that leads me to believe it's false, right? Like anytime you say all cases, right? So we know that's pretty much got to be false. But what's wrong with this statement? Exactly. So stock dividends, number one, it's false because stock dividends have no effect on stockholders' equity. And secondly, liquidating dividends could reduce stockholders' equity. All liquidating dividend means is that you debit paid-in capital and credit cash. Right? So a form of a liquidating dividend would be to debit APEC rather than retained earnings, say it's for 200, and credit cash. Okay, so it's false because a liquidating dividend does reduce equity. Not always. Stock dividends that debit APEC may not. Okay. Okay. Any other questions on that one? So everyone knows it's false, but you have to explain it. So those are the two reasons. All right, how about ready for the second? Let's go to the second. And I want to know that what I'm asking is when a stock dividend is less than 20 to 25% of the common stock outstanding, company is required to transfer the fair value of the stock issued from retained earnings. That's the market price, and as we said, I'll double check that whether it's. I'm pretty sure it's the close, but we'll check that. Okay. Anyone still not in yet? Is everybody in? Just want to make sure. I got 15. I'll give you, might as well run it through. Okay. Once again, you ask the guys in the other class, don't you? All right. Yeah, that's right. Okay. Yeah, it's true, and but I'll give you credit for that one because no one will argue it except maybe me. Now, the other class, let me tell you what happened in the other class. We debated. I didn't grade it. By the way, if you're worried about the clicker scores, just make sure you answer them. You don't have to get them all right, and you don't have to have them all done. Just want to make sure I know who's here, so I can figure that out. But the other class, someone mentioned something which was good, and that is it could be false. Because if you look at the wording, it says, I would have probably taken this as true with an explanation. It says required. Is it possible that for a stock dividend of under 25%, you would not use the fair value? You would treat it as a large stock dividend? Remember that evidence to the contrary stuff? Right? So you would use fair value here because you don't have evidence to the contrary, and your assumption is that the decline in market price is not material. However, there could be a signaling effect, and that signaling effect could reduce the market price. it could be material, and 15% stock dividend could have a significant effect on market price, making the use of a small stock dividend or fair value incorrect, and you probably have to use par. So this question could go either way. So you have to remember, the rules are not, it's a bright line, but it's got some wiggle room, right? It's evidence to the contrary. So you'd have to look at all available evidence to determine whether or not the stock dividend of a magnitude of less than 25% is going to be an immaterial effect on the company's market price, and whether or not fair value on the date of declaration is in fact a valid measure of that stock dividend. Okay, so it could go the other way as well. All right, now, yes? Yeah, you can use fair value. Right. Yeah, exactly. If you say that, the decline is not going to be that significant, again, with the uptick that I had on the board before, if there's a signal and you know that, you announce the dividend, you see prices start to go up, you can use the fair value. Yep, absolutely. All right, now, on number 3, I'm not going to do the multiple choice. This one, same effect on a company's retained earnings and total stockholders' equity. I didn't ask this one because we could argue. Same effect, it's true in total. Nothing happens in total, but remember, what's the difference between a stock dividend and a stock split? In total, nothing changes. But if it's a stock split, it only affects the disclosures, not the numbers, not the dollar amounts. If it's a stock dividend, the dollar amounts and the disclosures are affected. It moves them, although the totals stay the same. It reclassifies the equity. All right, so that is it for dividends. That's the topic we wanted to get through in this module. Anyone have any other questions before we start in the last module, which will be the treasury stock? Okay, if you don't have any other questions, let me get rid of this and bring this up. Okay. Let me get to, sorry about that, let me get this up on the screen for you. And let's go. Okay. All right, so in the last module, last topic, we're going to look at share repurchases. And when we look at share repurchases, what I want to be clear, and sometimes this gets confusing, and it shouldn't, because share repurchases can take several forms. So you could have treasury stock transactions, or you could have share retirements. Now, share retirements are going to be treated somewhat like a treasury stock transaction under treasury stock. We could have the cost method or the par value method. Under the share retirement, we're going to use what is called the retirement method.